All right, looks like we're at time. Thank you for joining us, everyone. My name is Chinna Chun, and I'm with NACBA and the Consultants Training Institute. Before we get started with today's Around the Valuation World webcast, I want to go over a few housekeeping items. First, to obtain CP credit, you must answer all the poll questions that pop up on your screen during today's webcast. CPE certificates will be available on the nacba.com portal within 7 to 10 business days after today's presentation. If you have any questions during the webcast today, please use the Q&A option in Zoom for questions for your presenter. If you have any technical questions or questions about Zoom, please use the chat feature as those will be directed to me. And with that, I'm going to turn the time over to Mel, who will get us started with their first presentation today.
Thanks, Chinda. Welcome to the, I guess it's the second session of, or the first session of June. So we've got a program that is going to be, I mean, I was just looking at the agenda. It's going to be an amazing program. We're going to talk with, start off with Gregory, as we usually do, about the body of knowledge and all of the resources that are available there. And then Stephen White is going to have a conversation around the business sales and success fees that you can add to an advisory practice with John Leonetti. And then we're going to talk to Janae Castell with some industry economic updates and move into one of the most popular sessions, which is our judges panel with Michael Kaplan and our esteemed judges. And then we'll finish up with valuation verdicts with Michael Mulder and growing your brand with Dimitri Yimga. And we'll start in right now with Michael Gregory. Are you there, Mike?
I am. It's my
Awesome.
pleasure to be with you here today.
And always glad to have you. Those of you that don't know Mike, he is a constant continuing contributor in the valuation community, the valuation industry, and to the NACVA, and as an author of a number of books and mediation and valuation stuff. So take it away, Mike.
Thank you very much, Mel. My pleasure to be here today, as always. We've got a full schedule in this upcoming segment. We'll be going over 6 different articles. First one is one of my favorite court cases reveals what makes a guideline company. It's a classic by Gary Trugman. This is from his book, but I'm going to focus on a particular court case that he has within the book. Department of Labor finally agrees to provide regulations on ESOP valuations, and I'll talk about that. The Modern Post's 2023 edition of ERP paper. Be cautious with AI, advises Allerding. More of Hitchner's myth busting regarding restricted stock. And Cost of Capital Navigator now has a company level beta module. It's a work in process, but what it has available right now is even pretty cool. So in terms of objectives for today, apply a methodology for guideline public company method. Note that the Department of Labor agrees to provide regulations on ESOPs, and we'll talk about that. Reference to Modern's 2023 ERP paper. If you haven't downloaded it, I'm going to recommend you do that. Be careful with AI, advises Allerding, and he's got an example as to why. Note Hitchner's myth busting regarding restricted stock, and consider the new module with Cost of Capital Navigator from Kroll. So here's a court case. Gary Trugman summarizes it here from his book, and it's Joyce Hall versus Commissioner. And that 92 TC 312, the TC means tax court. Now, most of the time when you see a valuation case, it's going to see TCM, means tax court memorandum. A TC means the court's going to apply this in other cases. So that means really pay attention on this one. It's from his book, Understanding Business Valuation, and this Joyce Hall is from Hallmark Cards. I think we're all familiar with Hallmark Cards. And he has in the article, Gary Trugman quotes from Revenue Ruling 59-60, and he points out, guideline companies are supposed to be in the same or similar, underlining similar line of business as the subject company. It's not underlined in the Revenue Ruling, but that's the focus of today's commentary with guideline public companies, similar. So in this case, the IRS expert used one comparable. There's a very major competitor with Hallmark Cards, and that's American Greetings. That resulted in twice the taxpayer's expert values. The taxpayer had 2 experts with multiple guideline companies. And in essence, the court went with the taxpayer's experts 100%. So what's involved here? The first expert was First Boston. They used American Greetings, and they picked out a number of other companies, some of which you may recognize. The AT Cross Company, that's Cross Pens and Pencils. Avon, probably familiar with them in terms of cosmetics, where I think we're all familiar with Coca-Cola Company. Lennox is Fine China, and Papercraft Corporation is a gift wrapping manufacturing. Well, how are these companies similar with the First Boston valuation? They said in their analysis, they analyzed the entire market segment, and they came back and said, we looked at those that produced brand name consumer goods, were leading companies in their industries, had publicly traded stock, had business and financial characteristics similar to Hallmark. And that's how this expert came up with their similar companies. The second expert was from Shearson Lehman. They use McDonald's, Anheuser-Busch, IBM, there's Coca-Cola again. It's unclear, but I think they used American Greetings, but it's not clear from the commentary in the case. The second expert chose comparables based on what? Solid, low-cost consumer non-durable goods, stable, high-profile quality reputation with consumer leading brand names, solid products differentiable from competitors, and sold products that involved elements of social expression. So they gave the court reasons as to why they were similar. So what the court say? A hypothetical buyer would consider more than one alternative. Now here's a real bias commentary. The IRS expert, this is again back in the 1980s, the IRS expert was instructed to prepare an analysis that would lead to a higher value. Not a good thing to tell your expert to come up with something high or low. Petitioner's experts presented analysis that clearly articulated the careful comparisons. So overall, what's the commentary? Look beyond just the obvious. And this is an excellent example of thinking broadly with VB experts. And that's what the tax court's saying. You need to look broadly if you're going to use guideline public company method. Then DOL finally agrees to provide regulations on ESOP valuation. So that's the good news. DOL and valuation profession are going to work together. According to the ESOP Foundation, they're kind of wondering whether this is really going to work or not. There's a deja vu here. The Department of Labor indicated previously they would follow through and work with the public, and they didn't do it. Now, I think the difference this time is the DOL has been losing in court consistently. They've been making administrative decisions consistent with how they've lost. So what's missing here is trust. And when folks write regulations, they can write them in a lot of different ways. I've helped work with regulation writers when I worked for the IRS. And I can tell you, those are attorneys. There are no business valuers that are writing the regs, just attorneys. And those attorneys might mean well, but they don't always know necessarily what they're doing because they're attorneys and not experts in the area, in this case, ESOP valuations. So this is a work in process. Yes, there will be regulations, but we'll have to wait and see. Damodaran, this is from Professor Aswath Damodaran, NYU Stern School of Management. And he comes out with a new edition each year. It's a forward-looking edition. And looking at the equity risk premium, he has determinants, estimates, implications for 2023. This is 14th edition. He likes to remain in the academic world. It's a 143-page paper. I have downloaded it. I would encourage you to do that too. And the real focus is here is he's focusing on an ERP going forward. And I read through his rationale. It's a good read. And he says an ERP can be anywhere right now, starting the year for 2023, somewhere between 4.24% and 5.94%. Depends on your assumptions. And he gives you some ideas to look what might your assumptions be when you're going to choose an ERP in 2023. And then Jim Allardine, he wrote an article in terms of advising us to be cautious with AI. What he did is he went into Chat GPT and he gave that Chat GPT some basic questions. The responses were incomplete, and in some cases they were absolutely wrong. He asked about the deal stats database. And it's an interesting little commentary. It did not recognize, AI with ChatGPT did not recognize deal stats. So he just changed the name to Pratt stats. When he did that, ChatGPT, it was impressive that it said, oh, we apologize. We were using Pratt stats. We need to update that for deal stats database. And then they answer the question. So that's kind of cool in terms of interactive component. But it's currently not very useful for professional purposes, but AI learns based on what feedback it gets. So it cannot access beyond a high level right now, but AI learns rapidly. So we'll have to see what happens. More on Hitchner's myth busting regarding restricted stock studies. He says it's patently false that restricted stock studies and DLOMs cannot be relied upon to determine a DLOM for federal tax purposes. He says the IRS view, first there's the IRS job aid. I championed that back in 2009. And in the April issue of Hardball, he expands on that commentary. He specifically comments on some of my blogs. So I blog weekly at mikegreg.com/blog. So I just took Michael Gregory and shortened it, mikegreg.com. But on the left-hand side, if you go to my blog page, I have articles that are blogs that deal with BV things, including DLOMs and some other things. I put a series of 6 of those together. And he quotes that blog from my DLOM, or from my blog on DLOMs back in October of 2022 with an update with interactions from the IRS. And then the Cost of Capital Navigator. It now has a company level beta module, which is pretty cool. It allows users to estimate their own industry capital asset pricing model as levered, unlevered, relevered for individual elements related to betas. It can calculate 5 different beta estimates, perform sensitivity analysis, which is pretty cool. Uses different, you can look at different currencies. If you have international things, different frequencies, look back periods, you can try different market indices. Now it's going to be enhanced later this year to include archive estimates and beta trends over time and more, but you can use it right now with the things that are listed here in those first 2 bullets. So in terms of resources, here's the article from Dimitri on equity risk premiums. This is the a link to the April issue of Hardball with Hitchner on DLOMs. Here's the DLOM job aid from the IRS if you want to look that up. And this is that particular blog that deals with DLOMs back in October 22 from my own website. I have other blogs you can take a look there. And there's also, here's Jim Hitchner's book on DLOM Guide and Toolkit, which I think is the best tool out there for using to determine DLOMs. You can come up with a whole host of different DLOMs using that method and determine which ones might be applicable. And then each month I come forward and these are the sources that I use in order to come up with this little 10-minute segment. This is my email and my phone number. If you've got other ideas on what you want me to handle or any questions or comments, come back to me. And with that, I'm going to pass it back to you, Mel. Take it away.
Thanks, Michael. So good to have you, and always a wealth of information and stuff that we need to dig in further. So thank you again.
My pleasure. Thank you.
All right, y'all, we've got the first polling question up, so make sure that you answer it. Don't just click it away if you want to get continuing education. And as you're doing that, let me introduce our next segment. Our next segment is how to add business sales and success fees to your advisory practice. This is with Stephen White, who is a CVA. He's a managing partner of Onyx Partners Group, dealing with valuations in bankruptcy, gift and estate, ESOPs, and consulting. Steve is going to be having a conversation with John Leonetti. Steve, welcome aboard, and I'm going to let you introduce your guest.
Oh, thank you very much. It's always exciting to be a part of this session. I have the distinct pleasure of introducing our guest speaker today, John Leonetti. He is the founder and the CEO of the International Exit Planning Association, as well as the CEO of Pinnacle Equity Solutions, which is an exit strategy firm that specializes in exit strategy design and execution services to advisors for their privately held business owners. Now, most of the audience is pretty much familiar with John and his name, because he's also a friend of NACFA, but he's also a nationally recognized leader in the exit planning field and has been interviewed on numerous national television programs such as ABC News, NECN, and numerous national radio programs. And he's also been quoted frequently inside the Wall Street Journal on numerous occasions. And as a subject matter expert in this particular field, John's credentials speak for themselves. He not only has a master's in finance, he also is a certified financial planner. He has earned his designation as a certified merger and acquisition advisor. And by the way, if you don't know this or I didn't mention this earlier, John is also an author. His latest book is entitled Exiting Your Business, Protecting Your Wealth, a strategy guide for owners and their advisors. And I have actually recommended that to a couple of clients that we've done M&A valuations for that were interested in learning a little bit more. So, John, it's a treat to have you here today to dive into how to add business sales and success fees to your practice.
Thank you, Stephen. I think the host has turned my video off. I think I need a little technical help here.
Okay. Well, as long as we can hear you, which is great. I know that
Yeah.
there you are. There you are.
Thank you.
I know that our segment is not that broad, so I much time. So I want to jump right in unless there's something else you want to add and share with the audience that I did not mention in your introduction.
No, other than I saw you present last year on this similar topic. I thought you did an excellent job. I know you're
Thank
well
you.
versed in the topic, so I look forward to the conversation.
Thank you. Thank you. Well, I will jump right in, John, and ask you this. So with International Exit Planning Association, we already know that it helps advisors guide their business owners as far as an exit strategy. Here's my question for you. Can you provide some details on the legislative change that created a dynamic shift in the area that took place earlier this year?
Yeah, thanks, Stephen. So something pretty dramatic happened. This led to conversations with leadership over at NACPA. We thought it would be a really interesting topic. So we've got a couple of different ways people can learn more, but I'll try to give you as much as I can in 20 minutes here in terms of what's now available. So as the slide indicates, for almost 90 years, this was the Securities Exchange Act of 1934. And that was accompanied by the 33 Act, which followed the Great Depression and the collapse of the stock market. And those laws were intended to root out the type of misbehavior that allowed the stock market to crash in the late 20s and cause a depression. Well, inadvertently, within that language, the privately held business was declared a security, and the law said that the sale of any security required licensure and affiliation with a broker-dealer to affect those securities transactions. What the law was really intended to do was to protect really that individual whose life savings was placed with a financial advisor. And if that financial advisor was doing stock sales, buying and selling Coca-Cola and the same stocks that Michael Gregory mentioned, and earning a commission, that would not be done in a way that put the broker's interest ahead of the consumer, the investor, by churning the account. That was really the intended audience to protect. However, inadvertently, the sale of privately held businesses, because a privately held business is a security, was brought into this, therefore requiring licensure for anybody selling privately held businesses. Quite surprisingly, because I've been part of the legislative and lobbying efforts for 16 years to see this change made, I was surprised because we didn't have any advance notice that it was coming, that in the Consolidated Appropriations Act, which was known as the Omnibus Bill in 2023, on December 29th, President Biden signed that into law. And within that was the Small Business Mergers, Acquisitions, Sales, and Brokerage Simplification Act, which is otherwise known as the Brokerage Simplification Act, which now created an exemption so that the average advisor who's selling a privately held business at the federal level is no longer, for most practical purposes, required to have a securities license to effect that transaction. The reason that we found this particularly compelling is that we know that a lot of NACVA members have business owner clients, and they might enjoy the opportunity to participate in selling that business. But we also know that many of them, many of you out there, are compliant with the laws, as I have been for the last 20 plus years, holding the securities licenses and being affiliated with a broker-dealer. That now has created a dynamic change so that the requirement of a broker-dealer and a license to collect success fees is now there's an exemption against that at the federal level. It took almost 90 years to change it, and that's why we're gathering here today to talk about that. So that's an overview, Stephen.
So that's a great overview. And it makes me start thinking about other things that always are tied into this particular space. But what I think it would be important to learn a little more is your opinion on how this opens up the market to the non-licensed practitioners.
Right. So as I wrote here, for the last 15 years through our certified business exit consultant training course, we've been asking a very important question that our attendee on behalf of our attendees. At what point in an engagement with a business owner do your activities rise to the occasion of requiring licensure? So in other words, at what point are you acting as a broker? And the reason we had to ask this is because a lot of exit planning will put the average advisor in a position so that the business owner perceives them as somebody that can help with the business sale, but they have to be careful. So now the way that this opens it up is that we no longer need to ask this question at a federal level for the licensure requirement because we have this exemption in place. And it's a very powerful tool now for those that believed in compliance to start to think about not being in violation of the law by not having a license, but now being able to add business sales and success fees to your advisory practice on behalf of those business owners with whom you've earned that trust over a long period of time. Oh, I can't hear you, Stephen.
I'm sorry. Thank you. The question is, does the business owner consumer still have protection of licensure, which says that the licensee knows what they are doing and is ethical?
So that's a good question. So it's a little outside the scope of the 20 minutes here, but there's a reason why the exemption was put in place. The reason the easiest way to answer this is that the average business sale has a buyer and a seller, both represented by attorneys. The average business sale has multiple financial parties in there. There's an entire diligence process. So these are still considered securities transactions. You are not relieved of the title of a securities transaction, so that if you commit fraud or if there's misbehavior, there's still liability as it pertains to securities transactions. The exemptive release simply runs to the requirement of a license because the license had been deemed to be overly broad. It was not the intended audience. And this class of business owners are represented by attorneys, unlike a stockbroker, right? The average client isn't going to call their attorney when the broker wants to buy or sell a stock. So there are some differences. You're not relieved of liability for fraud and misbehavior, but you are relieved of the requirement for licensure.
Yeah, that was an excellent question. I'm glad it was brought up, and you gave a really thorough and such a short period of time. You gave a lot of insight into that. Thank you very much for that, as well as the question. My next question for you, John, is: as members of the NACBA, how can we benefit from this change, and essentially what are the immediate implications that we need to be made aware of?
Yeah, so let me give an example, and I have a few slides here. And then there's a couple of questions in the Q&A. I'll come back to those towards the end. So the immediate implication, right, just moving past what we do, is we were one of the first to market with this on January 10th. With the leaders of this legislative effort, Mike Ertl and Shane Hansen. Mike is an M&A broker and Shane is an attorney who've been part of these legislative efforts. We can provide access to this call, which we did on January 10th. We did a follow-up Q&A call. We had a few hundred folks attend the first one because it was such a hot topic and such a big deal. So how can NACVA members benefit, right? Well, let me just move ahead and show you why we created a course and why I speak from experience, right? We have the IEPA and then we have a transactional arm called Beacon Hill Equity Group. So one of the ways that we wanted to communicate the opportunity is to build a course, how to add business sales and success fees to your practice. This is going to be offered through NACVA, both at the upcoming conference, which you could attend live or virtual or a la carte. You could go to that session. There's also a class tomorrow where you can learn all the details. And in whatever time we have here, I'm happy to share as much as I can about what those details are. I've been doing this work as a part-time investment banker. We've created almost 400 million in liquidity, advised on a few billion. So I'm a pretty good person to teach how to do this without giving up the day job, right? I do IEPA, and we also are able to sell businesses. But if I was just to fast forward to the immediate implication, if the average NACVA member, the average CVA, has business owner clients, right? Then you can look at this as a two-phased approach. Everything that you need to know to engage the owner, and then everything you need to know to get the business into market and get the company sold. But the highlight of this, of course, is encompassed in a case study. And this is really the answer to the WIFM, what's in it for me, right? An average fee, as evidenced by industry studies that talk about the average percentage, much like a home sale or real estate, business brokerage and success fees are paid on a percentage of deal completion. So in this example, if Acme Brewery was to sell for $12.5 million, an average fee for that might be $450,000. If we, using a double Lehman formula, if we use a two-tiered formula, we could get almost $600,000. And that's the WIFM, right? If those listening today are saying, hey, look, I've built these relationships with business owner clients, I've done the valuation for them, I've become their trusted advisor, perhaps you're doing other work for them on the financial side, then this opportunity is out there for you. It's not simple, but we thought it might make sense to explain how you could do this, how you could add this to your practice, and benefit by receiving these types of fees. This has become a very hot topic inside the IEPA because, you know, what is an average valuation, right? Is it $10, $20, $30,000? You earn that relationship with the client. But, you know, many folks in the IEPA are doing that work, but they also want to know about the opportunities to really expand what they're doing and either lead and try to pull 100% of this fee in for themselves, or affiliate and partner to participate in a portion of this. Now, what's significant about this is that prior to this change, which only went effective March 29th, so it's only been a few months since it's been effective, the average advisor needed a license to participate in fee sharing as well. So if an M&A advisor was affiliated with a broker-dealer, there are preclusions on sharing fees with non-licensed individuals. Those now go away because the M&A advisor no longer is required to be licensed. So in order to share the fee, it's now permissible to share fees with a non-licensed advisor who refers a transaction or participates in the transaction, or perhaps wants to earn the entire fee. And as I wrote here, the goal of the course that we're teaching is to illustrate what needs to be done to earn success fees so you can decide if it's for you and then make that decision. But more importantly, to give the business owner, and this is why I think this is really positive for the marketplace that we serve. As we know, privately held business is the engine of the US economy. We create more jobs and more wealth than any other segment. And now the business owner will have an easier time working with trusted advisors who are already knowledgeable about their business so that those advisors can extend their services, again, repeating for emphasis, without being in violation of federal law. Now, Stephen, somebody did ask about federal versus state.
Before we go to that, we had a few questions keep populating, which is great. This is an excellent topic, and obviously you and I could have a dialogue on this much longer than our allotted time. Two quick questions. One, the non-licenses, this is nationwide, so it's not just any specific state. Is that correct?
Well, there's some in the Q&A here as well. So okay. I mentioned deliberately a few times, this is an exemption at the federal level, which is huge. There are currently 20 out of the 50 US states that have provided state level exemptive relief. So we have not completed the process entirely of each state that needs to also provide exemptive relief to be 100%. But if you're operating within those states and you have buyers and sellers within the states that have that exemptive relief already, then you are 100% good to go. You've got a federal exemption and you've got a state level exemption. Now, what's important about this, Stephen, is that 20 states did this on their own before the federal law change.
Okay.
So I met with my state senator and have already lobbied for the state for the state rules to change here in Massachusetts. And I'm working on that. We're encouraging others within the IEPA to work on that. So we're not 100% there, but there's every reason to believe that because the states were following the Fed and 20 out of 50 states had already broken from the federal legislation with exemptive relief, that it should move quickly to clean up the rest of the states. So, Stephen, there was also a question, can you do a Q of E calculation value and still collect a success fee? That's a good question. I don't know how you would tie a success fee to doing a Q of E or a valuation, but I guess so. Yeah, I mean, there's no federal preclusion now from doing that, but a Q of E is not a sale of a business, right? Q of E is just analysis, right? Anyway, we do have a list of states. We'll go. I don't have them on these slides. Apologies, but I can certainly provide them. But like I said, with the amount of time we have left, I'm happy to go through as much of the course material as we can. Somebody's asking, does this mean the series 7 and 66 are no longer needed? Yes, that's exactly what this means. So it's the series 79, the series 82, those licenses plus the affiliation with a broker dealer is no longer required to sell a business. Stephen, let me say one more thing. In 2014, the SEC issued what's called a blanket no action letter. And it was out to the industry. And they said, hey, business owners were never the intended class to be protected by this legislation. So if you don't have a license, we're not going to enforce compliance with that. So many would say, well, if basically the police are saying you don't have to worry about running red lights at night, why do I have to worry about running a red light at night? Well, because if you get into an accident running a red light at night, it's not the criminal penalties, it's the civil penalties that are going to get you, right? So because it's still against the law to run a red light, even though the people enforcing the law say they don't care. So that analogy somewhat holds here because the SEC was already on record 9 years ago saying, we don't really care if you have a license, but it took that much longer to get the law changed. And now through this act, the 34 Act has been rewritten and now it's no longer required. So that's an important distinction as well. And then the requirement for licensure, broker dealer affiliation falls away also.
That's fantastic. So we have about another 5 more minutes remaining in this particular segment. I do have a question, and they wanted to ask if you could just elaborate a little bit more on the double Lehman formula. Is this just a normal practice for business brokers, or is it? Go ahead.
Again, I want to give you as much as I can in the 20 minutes, but this will be helpful, right? If you're in the smaller business market, one of the things that we'll teach is market segmentation. If you're in the business brokerage market, small company market, less than 5 million in revenue, typically the double Lehman applies, where you get paid 10% on the first million, 8% on the second. But in the lower middle market, which is basically 5 to 150 million in revenue, it's a little bit different. We'll talk about data that supports percentages that are at market. So that typically what you do is the second example here is more accustomed to a lower middle market deal, where in the orange shade, you get a certain percentage up to a break point that is a good value for the business. And then above that, you align interests with the business owner, say, hey, if we exceed this value, which again is why valuators are really in a great position to do this type of work, because you've already done a valuation on the business and you've had the owner read that value. So if you exceed that valuation, your interests are aligned with the owner so that that percentage goes up. So it's common in the business brokerage market to see the double Lehman formula. It's more common in the lower middle market, slightly larger transactions, to see a two-tiered system or even three-tiered system. And that's something that we show in the course as well. Let's see, I think we're running really tight on time here.
No, we're good. We have about 4 more minutes. We're good.
Oh, okay, good.
Yeah.
Okay, so I have a lot more slides. There are different types of transactions. You could either sell 100%, or you could do a private equity recapitalization where the owner rolls equity into a deal. You should know about that, and you should know about the different types of transactions. Those are things that are helpful to know if you come into this world. There are ways to create buyer lists, and there's a number of different services out there. You want to have an engagement agreement that you're comfortable with, that shows you, that explains the terms and sets the rate which you'll be paid and the things you'll do. We have groups, research firms like PEI Services that have almost 5,000 private equity groups listed. So you can begin to do research on certain industries if you want to see who the buyers are in that space. And then essentially, the course is about walking folks through a process that's very much like a funnel that starts out with a launch of the deal to 60 or 80, or if the occasion is such that you do a broad market to 4,000 or 5,000 private equity and strategics. We talk about creating a teaser for this, which is a confidential listing that gets sent out. It teases the reader, says, yes, I see the industry, I see the revenues and profitability. I'm interested. I'll sign the non-disclosure agreement so that I could receive materials. And then we walk through the process of how long it takes. The industry average is 7 to 8 months to sell a business. We present it in 12 months, and we walk through an entire presentation of how long it takes to market the business, to execute upon finding buyers, to get to indications of interest. When we're out in market, we talk about how to compare different offers, how to size them up for the owner, how to set up to meet buyers through a management presentation, how to conduct diligence, and all the steps in the diligence process, including sample checklists. Somebody asked about a Q of E, how to position those services. If you're doing quality of earning work, how to understand where that fits and why that's so important. And then essentially to take a look at this in terms of who has the advantage at different stages in the process. After you grant exclusivity through the LOI, it's the buyer that has the advantage. So how do you manage that process to get to a closing where ultimately you can be written into the funds flow to receive this type of fee? And that's a high level of the steps that are involved.
Mm-hmm.
And I don't want this to be a commercial, but
but this is a lot of great information here, John. It's a lot. It's a lot of great information and enticing for those that are in this particular space, which I know that a number of us are, for them to go in and learn a lot more about it. So I wouldn't take that at all as a commercial. This is great information for them to learn. We have a few more questions, but I think we have time for just one more. I guess it's pertaining. All right. Will the selling a business training mentioned for tomorrow be recorded or given again for another date and time? I would actually have to ask Mel and Lena if that's what's going to be the case. But any final notes that you would like to leave, John, as far as NACFA members, anything that they need to learn?
Well, we're certainly recording it tomorrow. Future availability, we have a companion course at IEPA, so it's no problem getting access to it. There was another question, and this one's interesting. If someone does a valuation, then and then sells, is there a conflict? Is there an appearance of conflict? I think that there is. And I think that we're doing a transaction right now where the same law firm is representing the buyer and the seller. It was coincidental. We were able to recommend the law firm to our seller. The buyer had the same law firm. These things can be sorted out pretty easily with a conflict letter where
Yes.
the conflict is acknowledged, and then the client acknowledges, the client signs the conflict letter, waiving that conflict. I think that that would be applicable here for an appraiser that has a duty and then goes to accept a commission. I'm not 100% on that, but I think that typically that would solve the problem. But I will be looking into that. Somebody did ask that previously, and we just got.
You definitely have to have a conflict of interest letter before you start the valuation engagement. So when you do your due diligence, conflict of interest should be one of the first things as evaluator you should be doing a deep dive on. And if you come across that, then you do need that letter of conflict of interest.
Yeah.
And everyone has to approve of it.
So good.
So in any event, I was thrilled to come on. I know we're pushed up against time. We got a few extra minutes. Thank you for that. For those that are taking the class tomorrow, I look forward to seeing you. And we also have this session at the conference. There's 100 minutes on Thursday, July 13th. There'll be a session at the conference. You can do that a la carte, or if you're attending a conference, you can pick that session. And then if you don't get it from NACVA, you could always come to IEPA, where we did a course on this, and you could access the information there as well. Stephen, thank you very much.
No, thank you. Thank you.
John,
This has been a
John,
pleasure.
Before you go, Stephen and John, thank you for a great session. Real quick question, John, are you going to be, as part of that training, are there samples of some of those agreements that we need to have in place available to us?
We have samples of everything. And we can make some of them available as well. Yeah. So our goal with this is to have the attendee first decide, hey, I'd really like to be able to put myself in a position to make $200,000, $500,000, $600,000 fees. And now, am I willing to do what it takes? Right. We want to raise that awareness, and then along with that, Mel, we have a series of tools and templates and samples to help that along.
Beautiful. Thank you, John. Thank you.
Thank
Steve.
you, John. You're welcome.
Good stuff.
Thank you,
It
guys.
certainly beats the $2,000 valuation I did when I first started out decades ago. Thank God the statute of limitations is up. All right, on to our next segment. Our next segment is with Janae Castell. She is going to be interviewing and talking with Simon, and I hope I get this right, Rubinsohn, who is a chief economist. I'll let you, Janae, introduce him. But Janae has been got instrumental in a lot of different areas, but primarily focusing in the area of intellectual property, startups, estate valuations, and things like that. Janae, welcome aboard, and good to have you. I lost her. Where's
Great, thanks so much. No, I just almost forgot to unmute. So great. Thank you so much, Mel and Simon. It's so good to have you. Simon, again, is the chief economist at the Royal Institute of Chartered Surveyors, RICS. I don't normally say that whole thing out loud. So RICS, RICS. He began a 15+ year tenure at the RICS after serving as senior strategist at Barclays Wealth, where he was part of a team responsible for running the multi-manager investment portfolios and helping to develop structured products to widen the client offering. He's a well-known economist who's been quoted in various publications such as The Guardian, The Financial Times, and The Wall Street Journal. He's also appeared on the BBC News and Sky News as an expert commentator on economic issues. In his current role, Rubinsohn is responsible for leading the organization's research and analysis of global property markets. He's also responsible for providing economic analysis and forecasts to RICS members and external stakeholders. So I'm very excited to hear what he has to say to us today. Great. Okay, so we're going to talk today about risks in the global economy. And I want to start out by asking you, Simon, or saying the Organization for Economic Cooperation and Development, the OECD, which is made up of governments of about 37 democracies with market-based economies, collaborating to develop policy standards to promote sustainable economic growth. They recently pointed to a long road ahead for recovery, and walk us through some of these key risks to the global economy and that road to recovery.
Well, good morning or good afternoon, depending on where you all are. But Janie, look, that's thank you for the introduction. And clearly, there's a lot of uncertainty still about the sort of the trajectory for the global economy. We've had in the last few weeks, or particularly last week, really, a number of central banks deliberating on interest rates. You obviously had the Federal Reserve. A lot of discussion about skips or pauses, I believe, in the US. But what was quite clear from the communication and indeed the dot plot, so the Fed governors' expectations of where interest rates are going, is that it's premature perhaps to call the top on the interest rate cycle, and a lot of the communication reflected the uncertainties about some of the key issues. And obviously closer to where I live, we had the European Central Bank. They did actually raise rates. Admittedly, they're starting at a lower base, so we got up to 3.5 in Europe. But the messaging from Christine Lagarde, who's the president, was pretty emphatic. It was a very hawkish statement. So when one looks at the environment in which we're dealing with at the moment, central banks are still pretty wary, and they're wary because the inflation story, as we all know, hasn't really perhaps evolved in the way that central bankers, policymakers were hoping. Yes, headline rates are coming down. That, in a sense, is a bit of a no-brainer, really, when energy costs go into retreat. But the issue always is, what happens to that core rate? And in the case of, the Fed, they're looking at a super core rate. So you're always trying to narrow it down and trying to work out what is the critical components here. I suppose ultimately, all policymakers are scratching their heads and saying, are we in a position where we can see inflation return towards targets? And I'm really focusing on the core number there, without seeing, further upset in terms of economic activity. We're talking about labor markets, which are still pretty tight. And, it's a very difficult balancing act. I have to tell you, I'm seeing more references, and you're probably seeing likewise. I'm seeing more references to, not a hard landing, but to a recession in H2. Now, that may be a technical recession, one that us economists like to play around with, rather than you guys who are working in business actually have to deal with and see very visually. But nevertheless, it's interesting, that shift in discussion. And, one of the other points that sort of I've been focusing on, inevitably, given what we, what we've seen over the last few months, is how this adjustment in interest rates plays out in terms of the whole sort of credit conditions environment. And that could be the channeling by which, the monetary tightening actually does begin to really hit the economy. Perhaps some of that's gone off the radar because we haven't fortunately had a wave of bank failures after that initial round. But there's no doubt that credit conditions have tightened, and that is going to have an impact on how the economy performs going forward. So it's a really uncertain environment. And, I certainly would envisage we're looking at further interest rate hikes over the coming months.
Okay, great. And just, is there anything else that you wanted to point out? You mentioned the stickier inflation in spite of the energy costs coming down, and really emphasizing that core rate. Any implications that you think from a valuation standpoint of how we look at, say, the risk-free rate or any of our risk rates that we're using?
Well, I think inevitably, one's got to reflect that the sort of discussion that we're having here about macro conditions clearly has a bearing on how one views risk and how that plays out in terms of risk-free rates. And it certainly doesn't seem in the near term. And, we'll perhaps come on to this in a minute, but I think that fundamentally, and I thought I wanted to make this point as well, actually, in thinking about sticky inflation, and then we can look at that risk-free rate issue. But one of the challenges, I suppose, is recognizing what's happened. I don't know, you may probably haven't heard of the Bank of England's chief economist, a guy called Hugh Pill. Now, he basically put a very simple proposition forward about 6 weeks ago, and that is when you get an external shock, an energy shock in particular, the implication of this, it makes energy importers poorer, or net energy importers poorer. He was actually pilloried for saying that, because there are clearly, there's distributional issues, and not everybody in the society is going to be poorer, and how that distributional issue plays out is very much down to for the government to address. He was making a general statement, and I think part of the challenge here is our failure to acknowledge what's happened. And I think you could argue that it's businesses as much as wage bargainers, labor as well. There's a lot of discussion about not just whether perhaps labor is being a bit too aggressive in trying to minimize the fallout in terms of its living standards, totally understandable, but that businesses are also seeing opportunities perhaps where they have rising costs to perhaps add a little bit more on. And I'm sure you've seen some of the discussion around this. So, to what extent are we seeing, widening margins in some sectors? I mean, I have to question whether it's a generalized story, but I think that there may be some evidence of this to support for someone of, dare I say it, I'm probably one of the older people on this call, but I've lived through wage spirals in the past, and I've seen the deleterious effect that has, not just on the macroeconomy, but ultimately on, labor and business cash flows over the medium term. It may not seem that in the short term, but in the medium term, the impact on cash flows can be quite severe. So it's really important to get a grip on this.
Very interesting. And in that respect, we're talking more about our developed economies. What are you seeing globally in developing and emerging markets?
So, I mean, obviously it is really interesting because, there's a lot of discussion about China coming back into play. Obviously everything opened up after, being closed. And there was almost that relief rally or the relief bounce in terms of economic activity in China, in much the same way that the rest of the world, or much of the rest of the world, enjoyed that in 2022 when COVID restrictions were lifted. And, we saw the consequences of that at the time, which we're still living with in part. But there's some evidence that sort of the China story is stalled a little bit, and quite quickly, actually. Obviously, you've probably seen this, but the Chinese central bank actually cut interest rates last week, a clear signal that something is amiss. And on top of that, there's been some stories doing the rounds, and there's usually some substance when these stories do the rounds, that the government is looking to provide some support for the property sector. Now, we're all aware of the real estate story in China, I'm sure. So it sounds like there's a lot of intervention that is being considered at the moment. And that also adds to my suspicion that, the government's talked about, we're looking to try and target 5% growth. But it sounds to me, but that's a minimum rather than somewhere that they see as an average. They're really trying to provide, they will pull the levers to try and get there. Now, what are the knock-on effects of this? First of all, for APAC, well, APAC at the moment does appear to be, look, it's a very mixed area, but there is a lot of evidence suggesting that there is some slowdown underway. Look, one example, it's a small example, but Vietnam also cut interest rates last week. So, I wouldn't jump to too many conclusions on the back of that, but China clearly is not insignificant in terms of its influence in the region. So, if China is sort of struggling to sort of deliver sustainable recovery at the moment, and other parts of the globe are also having challenges, one would expect that to have a knock-on effect on APAC. Specifically about emerging markets, and that's where we get into this whole idea of sovereign risk. There there's a lot of reason to be concerned in an environment in which, you know, you've got interest rates going up. Typically, it does tend to ring alarm bells around sovereign risk. I think at the moment there is a lot of the analysis is relatively sanguine, and I use the word relatively in sort of inverted commas. I think there's a hope that it's slightly different this time, although that's always a worry when you hear that phrase, isn't it? And I suppose, you know, the red flags would be if, you know, we've underestimated how high US interest rates are going to go. If it's not just another quarter point or even another half, but that's not going to be enough, that would worry me. And if we start seeing the dollar rise quite sharply again, obviously it's come back a bit. If we were to see that reverse, again, that adds to the challenges for a lot of the emerging markets. So there are some issues there. It's not hitting the headlines at the moment, but it's one to keep a watchful eye on.
What do you make? And this is off script, so if you want to push this off, it's okay. What do you what do you make of some of the pushes from Russia and even China and other nations to get off of the dollar, especially for trading oil?
Well, look, I mean, I think that's something that perhaps is, you know, in a way, you know, this is not, you know, this issue about trading in dollars is something that sort of recurs every so often. And it's not the first time that it's manifested itself, but clearly that whole sort of US-China sort of dynamic, and perhaps it's unfair to say US-China dynamic because it, you know, it's more of a West-China dynamic, has intensified that sort of pressure. And I think that, you know, it wouldn't surprise me if, you know, particularly if this persists, that, you know, we will see a greater tendency to try and move a lot of trade, you know, with parts of the world away from dollar base. And that, I think, feeds into this whole idea of fragmenting sort of international relationships. Now, I don't want to get too weighed down there because we're all aware of the arguments. But if I was to just give one statistic here, and it's slightly worrying one from my perspective as an economist with a global sort of focus, you know, if one looks at the imposition of trade barriers on a sort of year-by-year basis, in 2017, there were about 500 new barriers imposed. Not an insignificant amount, but, you know, that's where we were. The figure for 2022 is in excess of 2,500. So I think, to me, that is as big a risk, you know, and in fact, from a global perspective, in terms of global trade flows, arguably a bigger risk than sort of currency denomination. So clearly that will, you know, that issue would have ramifications for the dollar. But thinking about that sort of, you know, potentially in terms of, you know, what it means in terms of trade flows, and, you know, again, you know, I would argue that trade flows are quite important in terms of delivering long-term sustainable growth. You know, again, it's something that one ought to be a little bit concerned about.
Yeah. Okay. So this further fragmentation is slowing some of that going on, and that may have some.
Yeah, and if you want to bring in a political dimension, and I'm always loath to do that, but, you know, if you're thinking about, you know, cooperation, whether it is around, you know, international cooperation, climate change, or, you know, something that's going on at the UN this week, talk about international tax rates, you know, and that whole discussion that's been building for a long time. And we've got those now newly agreed minimum standards. Not everybody's happy about that. But these sorts of things are much harder work in this environment, you know, and we can see a lot of that.
Yeah. Yeah. Is there anything from these, you know, macro points that you want to go back over? Or should we talk about a little bit about how these factors really play into the business valuation realm?
Yeah, let's do that. Let's move on to that. Yeah.
Well, I would like to know from you, because we deal a lot, you know, specifically with the cash flows and with the risk to those cash flows. So our numerator and our denominator, and kind of this simplified idea of business valuation. Do these factors lead you to consider more uncertainty in the expected cash flows of a business, or is it more about the amount of those expected cash flows for businesses, or is it some of both?
I think it's inevitably a bit of both, particularly, you know, we're not facing at this point, we don't appear to be facing at a macro level anyway, a contraction in the economy. Now, clearly, and it's always very difficult to talk in generalities because, some sectors are already beginning to feel some pain. Many others are doing quite nicely, thank you. So I think there is that balance that we got to have as a perspective. But, I think in an environment in which the interest rates are going up and, inevitably and always, we don't know where the peak's going to be, but that is going to increase some uncertainty, and that uncertainty it will increase stress in more interest rate sensitive areas, businesses, than in some others. So there is going to be some volatility around this because interest rates are going up, but we're really unclear, and at this point I'd say we're particularly unclear as to whether this is near the top or whether there is going to be a need for another round, a significant round of tightening. But on top of that, one would expect that at some point, at an aggregate level, because obviously I say subset, if you look at sector level, you're going to see quite a lot of pain already, but at an aggregate level where cash flows are going to come under more pressure. And, that would be reasonable. I mean, this whole idea, and it's an interesting idea that the Fed's always been trying, Jerome Powell's talked about whether you could actually have, not just a soft landing, but whether you could have, the economy landing without really actually seeing, a contraction in the economy after what we've been through. And I think, the judge, if you look at the labour market, you might say that, so far so good, except that we haven't got on that runway, unfortunately, because of where we are with inflation. But against that sort of background, I would expect to see a bit of pressure on cash flow. And when you think about risk-free returns, you're thinking about where are treasury rates going, and certainly in the short term, the risk is against the background that we were talking about here. I would have thought the risk is that they may well be a little bit higher, but obviously, there are views on this, and some people may well take the view that inflation is going to sort of come back to target much quicker, and there are optimists out there. I don't mean to be gloomy, but I think when I think about these sorts of discussions, I think from a business point of view, one's got to be as mindful of the risks as the opportunities. So I would confess to being a little bit nervous on that one, and feeling that there could be a bit of pressure on cash flows as we move forward through the course of the second half of this year.
Okay, very interesting. We can't predict anything, but having an idea of what's a reasonable assumption is fair, I think. On the timeline, if we're looking at those restrictive monetary policies and how they flow through the economy and how that delay looks, I mean, what kind of a timeline or what kind of a delay do you think we're looking at for these things to really work their way through?
It is so difficult. I mean, one of the things I would say, which I think is worth pondering, and that, pondering in terms of risk-free rates over the medium term, is, we've come off an extraordinary period, and everybody listening on this call will know that we come off an extraordinary period, not just during COVID, but really since the global financial crisis. I think, if we were to look at sort of Fed funds, and I know that that's a bit of an arbitrary figure really to focus on, but, we know it's barely been, I think, above 2%, with the exception of the current period, briefly just before the run up to COVID. So now, historically, that is quite unusual, and that's reflective of, interest rates more generally having been at extraordinary levels. And I think we've got to think about, over the medium term, where are interest rates likely to settle? What is likely to be a reasonable risk-free return in the medium term? I would have thought, but for short rates, something between 3 and 3.5 might be viewed as an equilibrium. If you build in 2% inflation and you talk 1.5% real growth, I would like to think perhaps a bit more, perhaps. So then you'd be saying 3 to 4%. Now that, I think, is something that not many of us are really figuring on yet. So that is probably where rates settle. So I think that's something to ponder in terms of how we think about where the risk-free rate may actually end up.
Wow, this is really excellent. Very, very informed information. And yeah, I've appreciated listening to you and hearing what you said. I appreciate you taking time to come and talk to our listeners about, where we're headed in the global economy and how that impacts us doing valuations.
Okay, thank you very much.
Thanks, Janae. Thanks, Simon. Great stuff again. And it's always insightful to just start exploring things that maybe we don't look at so deeply in our day-to-day practices and should. So our next segment is we're going to introduce Michael Kaplan, who really doesn't need introduction. He's going to be bringing on our judges panel and having a conversation with the judges. And what do you do if you find fraud? How do you deal with that? Mike has been in the game for many, many years. We've been down this road for a while. Thank you, Mike, for being here. And I'm going to let you take it away and introduce our judges.
Great. Thank you, Mel. And I've really been looking forward to this session because we're dealing with something that has plagued most of us who have served as experts and financial forensics professionals in the valuation, in the forensic field for a long time. I want to introduce everyone to, I don't think Judge Driscoll is with us yet, but I know that Judge Platt and Judge Yates are here. Two of my absolute favorite judges with whom I have done a lot of educational work for both NACVA members, for people in the valuation of financial forensics arena. And we've also done a lot of educational programs for the judiciary, for the judicial community. We first met when we were working on a program for the National Judicial College, and we had what I thought was a really, really great program there. And that's evolved. Judge Platt, Judge Yates, and also Judge Driscoll are now involved in the American College of Business Court Judges, who we are now working with on educational programs for the judges to help them understand the ins and outs of what we are doing and help them better evaluate our kind of experts when they're on the stand. So they don't see two experts, they look qualified, they have the education, the credentials, the background, the experience, and one of them comes up with a value of $37 million and the other one comes up with a value of $200,000. And where do they go? So we're putting together and delivering a number of programs in that area. And it's going very, very well. Judge Platt is a retired judge. He's in the state of Maryland, and he is currently very actively involved in the world of alternative dispute resolution. And he is the leader of the Platt Group, headquartered in Annapolis, Maryland. Judge Yates is an appellate court judge in the state of Michigan. He was a trial court judge for many years. In recent years, he has been elevated to the appellate court. Is Judge Driscoll here? Let me just check. I thought I saw him appear. And
yeah, I think he had indicated he wasn't going to be able to make it this afternoon.
Oh, okay. I thought I saw his name appear on the screen. Okay. But in any event, if he shows up, Judge Driscoll is a trial court judge in Nassau County, New York. So we've got all the bases covered here. And one of the areas that has really been challenging for me in the work that I've been doing is when I get involved in a case and somewhere along the line, I discover there's fraud. And the fraud, sometimes there's fraud that's been perpetrated by one of the litigants with the other litigant as the target. And that creates some very interesting complications. Sometimes there's fraud where both plaintiff and defendant have been involved in fraudulent activity directed at other individuals on the outside. Sometimes that fraud is directed towards and I have to be very careful when I talk about this one, that fraud is directed towards the Internal Revenue Service. And it becomes really, really interesting when we deal with that. And sometimes we will find that one of the parties, or occasionally both of the parties, are attempting to perpetrate a fraud on the expert or experts in the case. And that becomes really, really challenging. So when we see this, when the red flags come up, we have to be prepared for a roller coaster ride. And so here we are. We're going to speak with our judges about how they approach it and how they deal with us and what kind of advice they would give us. So I'm going to ask a broad question, and the question is, I'm an expert, or Mel is an expert, or Janae, or Alina, or whoever is that expert in the case, and we're working on it. We start looking at various documents, and we see a pattern that indicates that there's been fraudulent activity, at least relating to the finances. What should the expert do? What advice would each of you provide the expert in terms of how to approach it, where they should take it, what they should do, what they shouldn't do?
I'll be glad to start on this one. First and foremost, you have to protect yourself and your reputation. What that means is you have to document everything. If I were in a situation as retaining counsel and an expert came to me and said, I think there's fraud on the other side, then I know it's incumbent upon me to make the decision as retaining counsel whether to bring it to the court's attention. The much more difficult situation is when you find fraud on your own side of the case, when your own client and maybe even your own retaining counsel is engaged in fraud. At that point, I would do nothing by phone. I would do everything by email. I would paper the file with a memo to the file, and you have to be willing to withdraw, even if it costs you some of your fee. Because if in fact you believe that your own client and your retaining counsel are engaging in fraud, it's far too easy to get caught up in that yourself. And even if you've done nothing wrong, to be blamed for it.
I'll reinforce everything that Jates just said and add to it a component that I've observed more often than I ever thought I would. And that is that when you are made aware of, if you notice fraud, and I'm using that generically, on documents sent to you to form an opinion based thereon by hiring counsel, and the transmission you receive is not preceded in any way by hiring counsel telling you that there may be fraud in the or that there's something there that I want you to look at. Whatever the admonition, warning, notice, whatever you want to call it, if you don't get that, you just got the documents, then you looked at them and you noticed what it appears he didn't notice. That is a problem, to say the least. I had an expert, and he wasn't a financial expert, but he used to have a technique that he used when I was practicing law, which is eons ago. He would call up and say, you don't want me to testify in this case, okay? And then would explain why. I do agree with Judge Yates that once you see that, particularly if it's from documents or evidence that you received from the person who hired you, you have to ask yourself, and unfortunately, I think this is the case, sometimes lawyers will send things to experts or even to opposing parties, and they won't have looked at them themselves. They will have had a paralegal or somebody on staff look, and whoever looked doesn't know enough to know what they're looking at. Doesn't tell the attorney because they didn't see anything that merited that kind of attention. So now you've got a situation where the person that sent it to you is implicated because he or she is counsel, and at the same time, they don't seem to know that it's there, or if they do, they don't understand what they were looking at. In that situation, although you still want to communicate to the extent possible, it depends on what your relationship was. The other thing is, what were you hired for? If you were hired to offer an opinion, you can bet this affects it big time. And hiring counsel needs to know that right off the bat. And it may affect it so drastically that it lowers to the point where it has no value, where it has such negligible value that, and it can dramatically change what the attorney does in the case, particularly if they didn't know about it, or if they didn't, or they should have known about it, but they didn't know enough to know what they were looking at.
I want to take that concept a step further, and I want to introduce the variable of the timeline of the case. I would think, and in my experience, doing thousands of cases over the course of the past almost 50 years in this business, that some of the cases, we discover that fraud, the fraudulent activity early on in the case. In other cases, counsel and the litigant are very, very careful as to what they keep us away from and which evidence they feed to us, which documents they feed to us, that it isn't until later in the case, and perhaps on the eve of trial, where we have learned of the fraudulent activity. We know the fraudulent activity would affect our opinions, and we are the ones who are going to be giving testimony tomorrow morning at 10 a.m. What would you advise an expert who found out on the eve of his or her testimony?
I'll take a stab. I'll echo what Judge Yates said. You have to be prepared to sign. You have to be prepared to refuse to testify. And if you're under a subpoena and the person and the hiring counsel or whoever subpoenaed you is enforcing the subpoena, they need to understand what the cost of doing that will be. The other thing, and then if they need to settle the case, which is often the instinct, when that happens, they need to understand, and a lot of lawyers, for some reason that I can't grasp, it's their business to know this kind of thing. If there's fraud on a regulator, IRS, certainly IRS, but I'm talking about any kind of regulator, banks in particular are subject to this. If there's fraud on any kind of regulator or anything like that, you can't work that out. It is unethical to try to negotiate silence on behalf of whoever knows it. And now we know, the expert knows. The same thing with criminal violations, whether it's federal, state, or regulatory. You cannot work that. You can't, in other words, if you settle the case, you can't make a part of the settlement that there'll be no complaint to attorney grievance. And the other thing is, if you as an expert, and I know some of your members are lawyers, they've got arguably, and it's somewhat clouded around the country, they've got obligations as an attorney, notwithstanding the fact that that's not what they're doing in the case. They're still a lawyer. And they're subject to all of the ethical considerations and disciplinary actions that are possible against a lawyer. And then, of course, on top of that, or in addition to that, whatever ethical considerations and disciplinary and membership and certifications are at stake. So they've got a problem, and it can't be. The instinct is let's settle this case and let's work all that out. In the process, you can't.
I agree with everything Judge Platt said. I want to draw a sharp distinction between fraud on the opposite side of the caption and fraud on your side of the caption. Obviously, if there's fraud on the opposite side of the caption, you're convinced of that. As long as you tell your retaining counsel, I think we've caught them in a fraud, in all likelihood, there's nothing unethical about putting that in your back pocket, taking the stand, and then answering questions honestly from your retaining counsel or on cross-examination that would reveal the fraud on the other side of the caption. The real dilemma is when the fraud's on your side of the caption. And as Judge Platt said, and as Michael suggested, you have to be willing to resign, even if it means the morning you're to testify, you back out of the case and let the chips fall where they may at that point. The worst thing that can happen is to take the stand and start answering questions under oath without your retaining counsel understanding that you're either going to be a part of the fraud if you go along with it, or alternatively, you're going to completely torpedo your own client's case by testifying truthfully, which you obviously have to do if you take the stand. So whatever you can do to get out of the case, you have to get out of the case before you hit the witness stand if you believe that your side of the caption is committing fraud.
I'm sure that many of us who are in attendance today and many other practitioners in our field have run into situations where we've discovered fraud, and to some extent the fraud was on our side of the caption, and we've had to be very candid with counsel. If you put me on the witness stand and ask me the following questions or anything that resembles that question, I will answer truthfully, and this is what my answer will be. Right. Counsel may not like that. But what about, here is a route, an option that I've seen taken a number of times, often enough to take note of it. And that is, the parties realize that there is a fraud there. The attorneys realize that there is a fraud there. And they realize that if the fraud becomes public, and if evidence of the fraud is put on the record in a trial, everyone's going to go down the tubes. It's like bringing everyone into the room, pulling the pin on the hand grenade and letting it go. I've often heard the suggestion, why don't we look for an arbitrator or a private judge who will agree to keep the proceedings private? My question is that something that you've seen? Is it something that you believe to be appropriate? Or is it something that becomes problematic for the judicial officer?
I've seen that before. There are lots of reasons to prefer confidentiality and therefore prefer arbitration, because arbitration can be private, of course. Court proceedings can't be. Once a court proceeding is started, though, in almost every jurisdiction, if you want to just dismiss and walk away, you either have to settle it or you have to get the court's permission to dismiss the case. Or if you're on the defense side, you can't just walk away if you've been sued. So once you start down the path of litigation and there's a case number and a judge assigned, it becomes infinitely more difficult. So if there are confidentiality concerns and you're aware even that they may infect the case, you need to talk to your retaining counsel before anybody files suit, because by doing that, you can insulate the case from public disclosure. Now, if you go to arbitration and you provide testimony to an arbitrator that perpetrates a fraud, you can get in trouble for that eventually too. But it doesn't create the public disclosure problems that you're highlighting, Michael.
Well, I agree with everything that Yates just said, and as somebody who has actually had the experience of being hired for that purpose. When you are hired for that purpose, it's likely that the arbitrator in a case that has any degree of complexity, i.e. a case in which a financial expert is involved, is going to be a lawyer. Not have to be, but is more likely than not. Again, we're talking about, as Judge Yates said, you have to have a distinction between what fraud are you talking about and on whom. If fraud can be not a crime, but if it's a crime and it's exposed, there can't be an agreement to keep it confidential. The arbitrator isn't agreeing to that and couldn't agree to that, even if he or she wanted to, and won't at their own peril. And so the confidentiality depends on what we're talking about. Is it a crime or is it fraud? Is it fraud? Is it lying to the opponent? Is it a certified public accountant? rendering an opinion that is on its face, not based on what the facts that he or she was given, or using a calculation that's totally discredited and he or she knows it or isn't what they contracted to do. That's a different kind of fraud. That's not a crime, arguably. But no arbitrator is going to agree to keep a crime confidential. Then the question is, what's the fraud we're talking about and on whom? If it's on a third party, particularly a governmental entity or a regulator, the likelihood of any arbitrator agreeing to do that is not only couldn't agree to it, may have a duty to disclose it.
Agreed.
So it's not simple. And I don't know how you do that without consulting the other side. And if they're involved historically or otherwise, then they got a bunch of clients to talk to who thought when they were doing this, there wasn't a problem. I mean, the classic one is they're, using corporate money for personal expenses. And, the question is that a crime? And if it is, do you want IRS to know about it? Because we're recording. If you're not recording, then, if I'm the arbitrator, do I put it in my opinion to explain why I didn't accept the expert's opinion, or if I did accept it because it was honest and because it exposed fraud, and part of that was if you want those findings out there, but it's not guaranteed to be confidential.
You've just reminded me of a number of cases that I've had where the fraud, even though it was perpetrated against other parties, also involved fraud with the Internal Revenue Service as the victim of the fraud, paying personal expenses with business funds and taking them as a tax deduction, or structuring. We've had some situations where one of the parties to the litigation set up several different corporations, at least one of them being offshore, and they had all kinds of transactions where they flowed money out of the country and took it as a tax deduction, when really it was money that went into their own pockets. And there are a number of things that we had to deal with. One of them is, even though one of the parties was the perpetrator of the fraud on the Internal Revenue Service, both of them benefited from that fraud. Both of them reaped the fruits of the additional funds that were available. And that, I found that to become complicated. In fact, I'll share a glimpse of that case. This was back in 1982. So, and my memory still works, and I can go back that far. 1982, I was on the witness stand in a case. It was a state court case, family law case. My first week in the case, I discovered $8 to $10 million that had been skimmed, that had been directed in some other direction, ended up in the parties' pockets, but it was taken as a tax deduction. And my retaining counsel put me on the stand. He knew the upside, he knew the downside. And because it was a family law case, back then they were taking a lot more risks in the courtroom. So I was giving my testimony as to the procedures I performed and what I uncovered in my procedures. And when I got to the point where it became very, very clear that there was a skim of $8 to $10 million, the judge looked up and he said, "I'm going to see both counsel in chambers."
Yep.
And he recessed the trial, took counsel into chambers, and he told him, "Do you want this on the public record? I know you put Mr. Kaplan on the stand to give that testimony, and you were well aware that that was what the testimony was going to be. But do you want this on the public record?" And at that point, the whole case went on hiatus, and people started behind the scenes to do what they needed to do to settle it. But, as fate would have it, 2 months later, they received a notice from the Internal Revenue Service that this company was being audited, or the series of corporations was being audited. And those companies that for which I found that additional skim, the Internal Revenue Service, their auditors came up with a number that was within 100 or 200,000 of my number. And it was, I mean, it was a nightmare for everyone. It was a nightmare for everyone. And, you know, as time goes on, it becomes, you know, more and more problematic and more complicated. Everyone lost on that one. I mean, it was a nightmare. It went on for too many years. And I also, along those same lines, have been involved in a number of cases. In 2015, there were 2 cases like this. Immediately after the case was over, I was contacted by the Internal Revenue Service Criminal Investigation Division, CID, yeah. And they wanted to meet with me, and they had their representatives there, and they also had an assistant U.S. attorney at the meeting.
Yep.
And they had, they had all kinds of questions, and I was sitting there thinking, they need to serve me with a subpoena if they want my files or certain other things that they wanted me to disclose. When I got down there, they had it all. They had it all. I'm not sure where they got it, but they had it all.
Yep.
That same year, oh, by the way, and one of the parties in that case ended up getting a free all expenses paid vacation for several years. The other one, and by the way, their concern was, would they be able to take the evidence that I had put together in the civil case, and would that evidence enable them to present a case that would rise to the level of reasonable doubt in terms of a criminal prosecution? Another one that I had, also immediately after the case was over, I got a phone call from a special agent of the FBI. And she said, Mr. Kaplan, we're calling about such and such matter that we know you were the expert on, and we are investigating the person who happened to be the opposing party in the case. We are going to be serving you with a subpoena for your file. Do you require that we serve you in person, or will you accept service via email? And I knew I was dealing with the FBI, and I didn't want to upset them. And I said to them, whatever is more convenient for you, that's how I would like to accept service. Yep. And I mean, it happened within a matter of minutes. And it was within a matter of a day or two beyond that. I mean, they had their files in hand. I mean, I really wasn't going to do anything that would be inappropriate at that point. But this happens, and we get involved in these cases all the time.
We get blindsided.
You didn't tell them that if they kept messing with you, you were going to defund them, did you?
Thank you, Mike, and thank you, Your Honors. This is we could go on and on. I know with this topic, because there's so much that we really need to know to keep us safe and keep us moving forward and everything. So, but I appreciate you guys coming on and giving us your insights. It's always invaluable.
Thank you very much.
Thank you. All right, we're gonna move to our next. We're gonna go from the judges to the verdicts with Michael Mulder. Michael Mulder, come on up. He's gonna talk to us about some valuation verdicts that may impact our practice. Welcome aboard, Michael.
Thank you. That's me. So the case we're going to talk about today is the estate of Cecil versus the Commissioner. It is a tax court case, much like, it actually is very much like the Hall case that Mike Gregory was talking about earlier. This particular case involves the valuation of minority interests in a privately owned business. It's a very large privately owned business. but not a whole lot of shareholders like Hallmark. This case actually involves the TBC, which is the corporate entity that owns the Biltmore estate. And if you think that I chose to do this case on this program because it gave me an excuse to put a picture of the Biltmore estate in my PowerPoint, you're not entirely wrong. So the Biltmore estate, really quickly, because I don't have a ton of time here, is this huge country home that was built by George Vanderbilt. I think it was completed around 1895. It's the house itself is 175,000 square feet, and it sits on 125,000 acres in Asheville, North Carolina. In 1914, when George Vanderbilt died, it went to his daughter, Cornelia Cecil. She, presumably at the advice of counsel, incorporated the property in 1932. Somewhere along the line, she transferred it to her sons, William and George. In 1979, there was a falling out between the two brothers, and George wanted out, and so he exchanged his shares in the company for the dairy operations and 3,000 acres of land. So at this point in the 1980s, the property or the business is solely owned by William and ultimately his descendants. In the 1980s, it became a subchapter S corporation, which will come into play in the tax affecting discussion. So I always thought of the Biltmore estate as this historic house that offered people tours so that you could experience what it's like to live in the golden age, or Gilded Age, that's what they call it. It actually is much larger than that. In addition to the house proper, which is used for tours, there are multiple hotels on the property. There are multiple retail outlets. There are 8 restaurants, including a catering hall. It runs river rafting tours. It has an equestrian training center. There's a whole lumber operation and several farms that provide the food that is used in the restaurants. It is, from what I understand, a self-contained entity. It has hydroelectric power on its own. It generates its own water and septic systems. It's just enormous. Over the years, they wrote several shareholders agreements that were intended to restrict transfers outside of the family. So one of the big questions down the road, as we'll talk about this, becomes discounts for lack of marketability. And those shareholder agreements are a key element of that. So in 2010, the Cecils, that is William and his wife, made a series of gifts of voting and non-voting shares to their grandchildren during the pendants, and then those gifts were audited, or the gift tax returns were audited, and during the pendency of the litigation, both William and his wife died, and so the actual representatives of the estate in the litigation are their children, I believe. The Cecils offered 2 experts. The first was a guy named Adams, who used a weighted average discounted cash flow, and it was a 50-50 split between the income approach and market approach. And in the market approach, it was 50-50 between guideline public company and comparable transactions. In his DCF, he used projections prepared by the company and a 15% discount rate. On the GPC, he used 5 allegedly comparable companies, which also becomes a dispute for the court, including 2 ski resort operators, a Canadian mountain resort, which might almost be comparable, I think, a Belgian theme park operator, and a US-based company that did global tourism stuff. Adams did not tax affect his results and applied a 20% discount for lack of control and a 30% discount for lack of marketability. Their second expert used an earnings capitalization based on distribution capacity, or dividend capacity. And he capitalized that at 10.7%. And he also used a guideline public company approach using just one company. And his argument for not using the asset approach was that because there were minority interests that were being transferred, they could not force a liquidation, and so the value of the assets isn't particularly relevant. He also tax effective the result and provided a discount for lack of marketability and no discount for lack of control because that was already built into the approach, being based on distributable value. The IRS also offered two experts, except they approached it a little differently. Their first expert was an art appraiser who looked at, using a market approach, valued 5 of the particularly most valuable works in the collection, stuff that had been accumulated by Vanderbilt originally when he built the property. And then the valuation expert used net asset and income approaches. Net asset approach was based on an appraisal of the real estate, which I don't think anybody disputed because there's no discussion of it in the case. Oh boy, I'm running out of time. And plus the value of the art portfolio, and then he did a value of the trademarks and trade name using a relief from royalty method. And basically, I'm going to skim through some of the details. The thing that's really kind of interesting about the case is it's this long dissertation about the failings of the various valuation experts. One of the things that came up was tax affecting, and the court determined that tax affecting is circumstance dependent, and didn't get into what makes appropriate circumstances versus not appropriate circumstances, and just concluded that because everybody conceded that tax affecting would be appropriate, he said, okay, let's tax affect this, and he used Morrison's 17.6% rate. No explanation of where it came from, no explanation of why that's a good rate. He also disagreed with Morrison's use of the asset approach, citing back to 5960, pointing out that earnings because it was an operating entity, earnings rather than assets are the best measure of the company's value. I'm kind of going to jump, you'll have to look through this on your own. It's a 20-page opinion, and it's a really good discussion of various approaches and the merits and the way judges will look at the way experts present information. The key takeaways for this one is this opinion is a stark reminder that the fact finder doesn't have to accept any expert's analysis wholesale. And basically what he did was like go into an old style Chinese restaurant where you got 1 from column A and 2 from column B, and basically pieced all that together to come up with its own result. And another key takeaway, at least for me, because I had always been taught that the net asset approach establishes a floor for value, and this judge basically threw that right out the window. If you have any questions or you want to talk about it to me, I'm more than happy to have a discussion with you. Also, if you want a copy of the opinion, shoot me an email and I'll send it to you. Other than that, my time is up and I will call it a day.
Thank you, Michael. You know, I actually had the opportunity to stay and speak there, and it's a beautiful property. And when you get stories behind it, it's kind of interesting to see. So, all right, let's move to our final segment of the program, and that's with Dimitri Yimga. He's going to talk about pro bono finance support for marginalized entrepreneurs with a special guest from a special organization. And everything. So, Dimitri, you there?
Yes, I'm there. Hi, my man.
All right. Well, I'll let you take it away. Bring us home, my friend.
Thank you. Hi, Ranjit. Thanks for being with us again this time.
Hey, Dimitri, good to see you again, and thank you to NACBA for having us.
So Ranjit is with SSTB, which stands for Start Small, Think Big. And we will be covering this section of Grow and Build Your Brand of this presentation. Let's see how to do it. Trying to figure out my slide here. Sorry about that. So Ranjit, without further notice, I'm just gonna go straight up and ask you, what is SSTB?
Yeah, thank you, Dimitri. So SSTB stands for Start Small, Think Big. We are a nonprofit, about 13 years old right now, started as a small business support organization intended to help marginalized entrepreneurs, and initially started out by offering pro bono legal services. And the way we did that, and I think this is what's interesting about our model, is we, rather than offer these services in-house, we connected small business owners with legal issues with lawyers at law firms who wanted to do pro bono services. Over time, we've extended the model to also include marketing and finance. But the principle is still the same. We are a nonprofit that is trying to address some of these real issues that small businesses have, who don't just suffer from lack of capital, but also suffer from lack of technical knowledge. And we're trying to connect these folks to organizations, to groups of professionals that can provide those services. So that's sort of what we do. And the goal of the organization is to do it all pro bono for these small businesses, and tilt the scales a little bit more in their favor, in order to make sure that structural inequities, be it gender, be it race, don't stand in the way of entrepreneurship.
Great. Can you, and I know you kind of touched up on that a little bit, but so what are the services that are provided through SSTB?
Yeah, so we group our services into sort of two categories. One are direct one-on-one type services, where we try to get bespoke / customized solutions to a small business owner. And the other, we also conduct like a series of public workshops that are accessible to small business owners, and we construct teams around these businesses, around these workshops as well. In terms of the one-on-one services and the workshops, our services land in three categories. They're legal services, marketing services, and financial services. And just to give you a flavor of some of those services that we do, so some of our top legal services requested by our businesses are entity formation. So we get a lot of businesses that either come to us without a legal entity set up and not quite sure what's the right legal entity for them. So that's one example. But another one which we frequently have is contracts. So we get businesses that want to set up the right contract so that they're protected in many instances, in all facets of their business. So those are examples of legal services that we do. And like I said, they're provided by lawyers who typically work at law firms, and these law firms want to provide institutional pro bono service. Finance and marketing, I'll come to finance last because that's probably of interest to this group the most, but marketing is similar. We connect a business owner to a marketing professional who can help provide insight into designing a website or SEO strategies, things to improve your business visibility, which I'm sure quite a few of you are dealing with as well as business owners yourself. And lastly, in finance, we're trying to help a business owner establish some basic financial infrastructure around accounting and bookkeeping. And we're also helping these business owners understand how to use their numbers effectively. So, what decisions to take. Should they hire more people? Are they ready to take on more capital? Simple budgeting questions, things like that. So that's a flavor of the services we offer our business owners.
Great. Thank you. So talking about NACVAR members, what can they bring and what can we bring on the table with SSTB?
Yeah, I mean, I think one of the, so we, just to give you some flavor of our reach, right? So we work with, over 3,000 businesses a year. About 1,000 of those are in sort of one-on-one type capacity. And we are a very, very tiny nonprofit organization. So, for example, the finance team, which I'm part of, has 2 members, and we have to provide services to all these folks. So we are very, very volunteer dependent. I mean, it is a lot of what we do is try to build systems and bridges and pipes so that we can connect small business owners, understand their needs with professionals who can provide those services. And NACBA is, being this very large organization, pan-national, we could really use your help in terms of providing some of these services, specifically around finance, to these small business owners. And like I said, the areas you'll be required to help on are very, very basic. So think of just the rudimentary bookkeeping systems that you probably started with when you started your business. That's what we want to explain to some of these small business owners, because they have never used bookkeeping systems before and are making assessments of their business by just looking at what's going on with their checking account, which you'll agree is not a very satisfactory way of understanding how the business is evolving. We also could use help because many of you are staring at the financials of your business. You're preparing budgets, you're doing business decisions based on numbers all the time. And we just want you to bring some of that knowledge to these folks as well, so they're a little bit more empowered about what decisions to take. So, examples might be, hey, you have these 3 products, A, B, and C, but product A is the most profitable based on the price and costs that you have. And it might make sense, all else equal, to focus on product A. Those types of pretty simple decisions can immediately result in better business decisions and hopefully growth for these businesses, but also it tends to be insightful, and business owners can walk away from these things with a little bit more insight into how to make the numbers work for them in their business. So to sum up, we could use NACBA professionals in these types of specific finance consultations, which we'll talk about, I'm sure in a second, around the setting up of basic bookkeeping systems and just helping a business understand these numbers really, really quickly. And they rarely take more than an hour of your time.
So thank you. And you mentioned that rarely it takes more than 1 hour of our time. As far as expectation, what should a financial expert expect in that 1 hour? What's going to happen? What's the structure?
Yeah, no, that's great. So a lot of these business owners, their financial infrastructure isn't highly detailed. So what we give to you before you arrive at these consultation sessions, and typically we try to do these about 2-3 days ahead of these sessions, is a little bit of information about the business. And it is more, it's actually not that detailed. So things you might see are, who is the business that you're going to expect? What do they do? A website, if they have any, and what their needs are. So we'll tell you that this business needs help setting up a bookkeeping system, or we'll tell you that this business is trying to figure out which of their products is more profitable or less. And that's pretty much the level of information you get before you head into this meeting, which lasts about an hour. What you do in that hour to have a productive session is to just spend your first 5 minutes as a volunteer, as a pro bono donor, just to sort of speak to the business owner and understand, okay, what is it that you need help with? And it might be, I've never used bookkeeping systems before, so maybe you can guide me through what to do. Or it might be, I'm trying to prepare a budget for this new venture that I have, but I'm not quite sure how to go about it. And then you spend, once you understand that, which is hopefully something you can do in the first 5 minutes, you spend sort of the next sort of 45 minutes just trying to expand on that. And you could, for example, prepare a budget. It doesn't need to be highly itemized. It doesn't need to have 40 lines. It can be fairly big picture, 6, 7, 8 line type big budget, so that the business owner is left with the biggest moving pieces that they should be aware of. And that's what takes up most of the time. The idea is not to solve every single problem if you can, but to leave the business owner with a little bit of insight. And then the last 5 to 10 minutes of your session is usually done, volunteers spend time with the business owner saying, okay, you've done this, maybe you should look at this part next. So you might, for example, have identified in the course of your conversation some struggles or challenges or adversities that the business owner is facing. And you might say, all right, just to sort of overcome those, you might want to consider doing X, Y, or Z, some sort of high level suggestions. That's typically what a session looks like. And it, like I said, you rarely spend more than an hour in these types of sessions.
Wow, great. Thank you. So we're getting close to the end of our time. Anything else that you want us to know about SSTB?
No, so I think we are very grateful that NACVA has been such a supportive partner of ours. And we go back a few years now, and we're going to just something to bear in mind. We're going to try to expand the opportunities for you to volunteer. So you can volunteer in a couple of ways. One is you can go find us on our website, and it's startsmallthinkbig.org. There's a button there that says you want to volunteer. You fill out a short form, and we'll get in touch with you and get it going. So if you don't want to wait and you're ready to do this right away, that's a way we could get started. But we're also hoping to organize some group events where there might be opportunities for you, your colleagues, or maybe to bring your entire team to one of these types of events, where we bring group volunteering capabilities, but also done virtually so that you don't have to walk away from your office, and you can do this again in an hour, and you can do it maybe in a paired setting or individually. So watch this space, and I'm optimistic that we'll have some of these opportunities flagged for you down the year. So I think that's something to bear in mind. If you feel you're curious about us and you want to get started right away, please visit our website, which is startsmallthinkbig.org.
Fantastic. Thanks again, Ranjit, for being with us. And like always, it's a pleasure. And thank you for everyone who's on the show with us today. It was really, really great. And I learned a lot from all the earlier people before me.
Thank you, Dimitri. Thank you, Ranjit.
Thank you.
Thanks for this and doing the good work that you're doing. So with that, we're going to close out today's program. And just remember that you get a chance to join us July 17th for the next AVW. And we'll have another great program for you. And we have a conference in July also. So check out the NACVA website and make sure that you're attending that conference. And hopefully we'll see you there. Thanks a lot. You guys have a great day. See ya.